Welcome everybody to this TEF Talk on Monday afternoon. Thanks you very much for coming, and we are very happy to host today John Mihalovic. He's the author of a very popular book, The Manual of Ideas, which introduces you to a framework of finding, analyzing, researching, and implementing the best value investing ideas. And among other great accomplishments, John is also a member of the Value Investors and Western Value Investors Club. It's a community for top money managers, and he also won the prize for best investment idea in that club. There could be many other great words said about John, but you came here to listen to him, so welcome, and the floor is yours.
Thanks. Well, thank you so much, Anna, for the overly generous introduction. I also want to thank Surab out in the Bay Area office for the invitation, which I was very excited to receive. And it's such a pleasure to be here at Google. I don't think I could have made it here if applying for a job, so this is kind of my entree, if you will. I want to talk about idea generation, and specifically from an investment angle. So how to find great investment ideas, and I put secret in quotation marks here because there really is no secret. So, but I'm glad so many came to hear the talk. And how do we really think about investing? And it has a lot to do with how we view the stock market, because when it comes to investing in public companies, you are transacting in a global stock market. It's very liquid. You can buy and sell at any time. And I think there's just a lot of confusion out there as to what the stock market really is. And there are also very many approaches, and it's actually in the interest of the financial community in Wall Street to make it seem very complicated so that you would just give your money to them and think that they're doing such a great job for you that they deserve to get paid a lot of money, when in reality, it isn't that complicated. So a beauty contest, the stock market is a beauty contest, that's really a criticism that economist John Maynard Keynes levied on the stock market or on Wall Street. And it's really this idea that a lot of investors and even professional investors will choose companies based on what they think other people will think of those companies. So everybody's kind of trying to play a guessing game where basically you're picking the prettiest face or the prettiest company, but it's not the one you think is the prettiest, it's the one you think others will think is the prettiest. And of course, as Keynes said in this quote, you can take that to the third degree and the fourth degree and so on, and it becomes very self-referential. And because a lot of people invest this way, this is how the stock market might act in the short term. It's very unpredictable, everybody trying to outguess everybody else. But that's really not how you can be successful in the long term. And by viewing the stock market as a pari-mutuel betting system, we're getting a little bit closer to the essence of it. Because really it's not about guessing the prettiest face or the best company or what others will think, because if there is a company out there like Google, that game becomes pretty easy. What becomes harder is calibrating that judgment versus what you have to pay to actually buy that company in the stock market. So as Warren Buffett's partner Charlie Munger says here in this quote, sometimes it's just really easy to see which horse is most likely to win a race, but that horse will have odds that are maybe 3-2, that pay 3-2, and some other horse that's clearly doesn't look as fast, may have odds of 100 to 1. And then it becomes much more difficult because probabilistically, the best horse isn't going to win 100% of the time. What if the horse that has odds of 100 to 1 can win 5% of the time or 10% of the time? It may actually be the better investment or the better bet in this case. And this quote from Warren Buffett kind of fits that paradigm. He says, we simply attempt to be fearful when others are greedy and greedy when others are fearful. And that really speaks to those odds. Because if you have everybody in the world believing that a company will go bankrupt, the odds on it may be so great that if it just doesn't go bankrupt, it may still be a mediocre company. You could actually do very well. And then finally, we really get to the essence of the stock market, and it's just a conduit to ownership. So Google would be a great company whether it's publicly traded or not. It would still have the cash flow it has. It would still have the customers that it has. And so you don't need the stock market to make Google valuable or any other company. And so it's basically just a place to buy and sell stock in companies. And what is stock? The legal definition tells you that it's just a partial ownership of a corporation. That's really what you're buying when you invest in a stock, and it may not seem that way because it's so easy to transact online. You're just looking at a stock ticker, and it's easy to forget that what you're really buying is ownership of a real-life business. And so, you know, you'll hear of all kinds of different strategies. You'll hear of people trying to invest based on charts. You know, they'll look at different bands and try to guess when a stock is breaking out or not. But that's basically removing yourself from the essence of what a stock really is. And when you do that, your chances of success go down dramatically. Because let's say you do invest based on a chart and you lose all your money, there's no recourse. You can't say, well, the chart looked good, and in every other case when that happened, the stock did go up. Well, there's no connection between that and what a stock is legally. Legally, it's ownership of a business. And so if you invest in a company and you're right, you can, in the worst case, take the recourse and acquire a majority of the stock, kick out the board of directors, put in your own directors, your own management team, and take full ownership of that company. So there you're getting to the essence of what a stock really is. And if you invest based on that essence, you'll be much more successful because you're just as close to the truth as can possibly be. And I want to talk a little bit about the mindset that you need to have to be a successful investor. So a lot of investors will think this way, kind of the small fish mindset, right? Let's say I have $100,000 to invest. Here's a bunch of companies and their you know, stock prices, their market value. Market value simply is, you know, what it would take at the current stock price to buy the whole company. And if you have the small fish mindset, you might just say, well, 100,000 buys a few thousand shares of any of these companies, and you know, my 100,000 is insignificant, so it really doesn't, you know, doesn't move the needle on these companies or the market as a whole. And the reason it's the wrong mindset to adopt is because just because your portfolio may be small, your role in the market is not insignificant, okay? Because the market is supposed to function efficiently because even small investors think about how well is company A going to do, how much do I have to pay to buy it, et cetera, et cetera. So you really need to think about not the scale of your portfolio, but the scale of the companies you're investing in. And so here's kind of the mindset B, which is really, I think, what successful investors adopt no matter how much money they're investing. And it's the same table as before, but we're just showing it in a different way. By the way, this is about 10 years old, some of these numbers, so it's changed quite a bit. But what I'm trying to illustrate here is when you look at it this way, you suddenly realize, wow, I can either buy all of Toyota for $99 billion, or for the same amount of money, actually a little bit of less, I can buy all of these companies on the left. Okay, and that's 100% of them. So you can either own all of Toyota, or you can own all of Ford, GM, and the other companies. And you may still decide that owning all of Toyota is the smarter investment, but at least you'll be aware what that decision implies, right? You're no longer on this slide where you're thinking, oh, well, I can buy a few thousand shares of Toyota or of some other company, and it's kind of all the same thing. So here you're realizing what you're really doing. And that mentality to really think of investing as an owner, I think, is very much in line with the legal essence of stocks. So here's a very busy chart, and we're not going to get through all of it, but there are a few points I'd like to make here. So one is all the way on the left, you see idea generation. And there are so many different ways to find potential investment ideas. You may hear it from friends, on message boards, read about a company in the newspaper. You could do a quantitative stock screen, searching for the cheapest companies based on some metric. So idea generation generally is the easy part, and we can overload ourselves with ideas. There's actually about 10,000 publicly traded companies in North America alone, and probably 20 to 30,000 companies worldwide. So there's a ton of companies to choose from. So where successful investors really generate their success, or as they call it in the industry, their alpha or edge, is really in assessing the investment opportunities. So I could give everyone the same potential company to invest in, and someone will say, wow, that's great, I want to buy it. Someone will say, no way. And that's really that decision. If you can get that decision right, you're going to be successful. So, given what we know now about the right mentality to think of a business as an owner, and would I want to buy the whole company if I could, let's walk through this a little bit. So a company will usually have real assets, okay, especially if it's kind of an old school company that maybe has factories. Let's take a General Motors, right? They got factories. They got all kinds of tangible assets. You would want to ask whether this company, at the stock price it is today, is trading for more than it would take to recreate it from scratch. And you're not going to be able to recreate a company exactly the same from scratch, but the idea is, what would it take, how much capital would it take to recreate the earnings flow and the basic business of a company? So if it's selling for a lot more in the stock market, you're not going to buy that stock, because what that's saying is there's an incentive for a competitor to come in, because they can recreate that same company for less money than the stock price implies. So, if the company in the stock market is worth $2 billion and you could recreate that business for $1 billion, there's an incentive for someone with a lot of money to come in, create that company for $1 billion, take it public immediately, and then basically sell the stock for $2 billion in the market. So that's where we're going to basically eliminate the company from consideration if it's trading above its replacement cost. Now, if it's below, then we go to the other extreme, which is liquidation value. And what is liquidation value? It basically means, what is this company worth dead today? So if you were to shut down the business or sell it and liquidate all the assets, how much money would you have left over? And if a company is selling below that, that's usually a low number, but sometimes companies actually do sell below that. I'll give you an example. When the shipping industry, these big ocean tankers, this transport crude oil around the world and so forth, when that industry is doing badly, it's doing generally so badly that no one wants to own these stocks, and they will sell on occasion for less than the scrap value of the metal used to build the ships. So you could buy those stocks for less than the scrap value. And then generally, managements at these companies, the CEO, they'll say, oh, the turnaround will come next quarter. Okay, maybe in a year. But after like 2 or 3 years, they'll start selling the ships for scrap themselves. And if they do that, and the stock is trading for less than scrap, you're actually going to make money, even though the business looks like it's going under. So that's another easy one. You would take control of the company, you'd liquidate it, you'd make money. Now, beyond that, those are kind of the two bounds, right? The upper and the lower bounds. You get into where you're looking at actual earning power of the company. And this is where most companies end up, unless we're, in a 2008 financial crisis type scenario where there were a lot of companies selling for less than their liquidation value. And what you would look at here is, well, how much is this company actually earning? And how much do I have to pay in the stock market to acquire the whole business? And there's no right or wrong answer. So you would basically decide, well, what kind of return is good enough for my savings, right? If a company is earning $1 billion a year and it takes $10 billion to buy it in the stock market, that's a 10% a year return. And then maybe you want to know, well, are those earnings growing over time? So my 10% in year one will be 11% and then 12 and so forth. Or are the earnings declining? In which case you'll want a higher initial percentage yield, right? So maybe even if the earnings are going to decline, well, if you can acquire it for 2 times current earnings, that means you're making 50% return just based on, and we have the mindset of capital allocator and owner here, okay? No longer just pieces of paper and stocks. If you can buy the whole company and in 1 year get half your money back in earnings, you're probably going to be fine, even if those earnings are going down slowly over time, because within 2 to 3 years, you've got all your money back, and then whatever comes after that is just gravy. Okay, so here you're making a decision whether the earnings yield, that's the earnings before interest and taxes, and these are some technical terms here, but I'm telling you the essence of what's on here. If those earnings divided by what the company is worth in the market exceed whatever return you require, because you're going to look at your alternatives, right? You're going to look at, you can put money in a CD, you can buy a bond, you can do all kinds of things. If that exceeds your return, you move on here. If it doesn't, you eliminate this particular company from consideration. And now what we're talking about here is we're looking at the business itself now, okay? Forget the stock market. We just want to know how good is this company, okay? And because we're dealing with money here, we want the company to make as much money as possible in earnings or cash flow relative to the capital it takes to build that company, right? So if I need to have a factory that costs me $1 billion, and that factory is then going to throw off 10 million a year in profit, that's probably not good enough, because that's a 1% return, and a factory is no CD, it's not a safe investment, and so forth. Okay, so you really want to know how good is the business. Google, for example, doesn't take a whole lot of capital, right? And it throws off a lot of free cash flow relative to that capital. So that's why it's a great business. And that's the kind of business you want to be in, because when you buy a stock, they're not actually going to pay you out all their earnings every year. Now, if they just took their earnings and paid them out, you may not even care, how good of a business it is, because you're getting those earnings. Like I mentioned, if you're buying a company with a 50% earnings yield and they paid everything out, you got your money back in a little over 2 years, and that's fine. But because most companies will actually retain those earnings in the business, you care very much about when they retain those earnings, they're going to invest them in their business, right? And what is the return on that capital, okay? Some companies pay dividends, okay? So that's a portion of the earnings usually. They won't pay out their whole earnings. They'll pay out half if you're lucky. So there you may care a little bit less because you are getting some cash back. But where you're not basically getting cash back, you want to know what kind of return is this company getting on the cash that stays in the business. And if it's a great business like Google, the problem actually becomes that it's very hard to reinvest that cash because the business doesn't require a lot of capital. So, take 1 year's worth of free cash flow for Google. If it could be reinvested in the business at the kinds of returns that Google is currently getting on its capital, that would be phenomenal. But because it's not a capital-intensive business, that free cash flow just kind of builds up on the balance sheet, and over time, there's tens and tens of billions of cash on the balance sheet. Okay? So if we like the quality of the business, as measured by the earnings divided by the capital employed in the business, then it's a good potential opportunity. And it still doesn't mean that it's a great investment. But you've kind of eliminated all the obvious candidates that are just not good enough. And then, once you're here, it becomes really more of an art, okay? Which company you're going to invest in versus another, right? So, and we're going to get into some of that here. So, here are some value-oriented investment approaches. And all that, you might have heard of value investing and growth investing. So growth investing usually is kind of the other mindset, or just the mindset of, well, which company is going to grow the fastest, and that's where I want to invest. But you're not really thinking, well, what if everyone else thinks it's going to grow the fastest and it's just super expensive? You may not make any money. If they have any kind of disappointment, like they miss a quarter by a penny, the stock can be down 20% in a day because there was just no value there. So we want to buy things that are more valuable than what we're paying for them in the stock market. And some of the well-known approaches in this area, there's the Benjamin Graham style deep value. And I start with that because Benjamin Graham kind of wrote the book on value investing. It's called The Intelligent Investor. And the style is today called deep value because you focus mostly on the assets. Like I mentioned, a shipping company with their ships and the scrap value. That would be deep value if you can buy something for less than the assets. Question?
Yeah, question. Like, how would you define
So, correct. So really what you're going to look at is the financial statements of a company. And that's where we get kind of into the language of investing, which is really accounting. So every company will have a line item on their balance sheet called property, plant, and equipment. And for a shipping company, that's where their ships might be. For a hotel company that owns hotels, that's where their hotels would be. And then they may have a footnote in their annual report that actually lists out the ships. It won't necessarily tell you the market value of those ships, but it might tell you what they're carried on the books and how much they've depreciated so far, and some detail. But you're going to have to dig a little bit deeper if you want to know like the market value of specific ships or specific real estate or something like that.
John, can you repeat the question? We couldn't hear the question.
So, yeah, the question was, how do you actually find companies that maybe have those ships and trade for less than that? So you could use a quantitative stock screener that looks for companies that have market value less than tangible book value. And tangible book value is kind of once you satisfy all the liabilities like the debt, what's left over for the shareholders using this accounting language, which is standardized, but it's not really correct in an economic sense, but you can use it for screening, and then you have to do your own research to decide, well, the book value may be high, but that's not actually if I wanted to sell the ships, so you take it down and do that kind of analysis. Now, Joel Greenblatt is a very successful investor. He's written a book called The Little Book That Beats the Market, where he talks about this magic formula. It's essentially a way to screen for companies that, according to my previous schematic, would kind of be in that green portion at the end, and then you can invest in them. And it looks at two factors. One is the high earnings yield, how cheap is a business, and the other is the high return on capital, how good is a business. And historically, just a mechanical screen of those companies that rank highly on those two metrics has outperformed the S&P 500 by several percentage points a year. And over time, due to compounding, that just is a huge number. Then we have what I call here Carl Icahn style, sum of the parts investing. You may have heard of Carl Icahn, or kind of these activist investors who will buy a big chunk of a company, maybe 10%, and then try to tell the company what to do so that the stock would be worth more or go up. And usually what they look for is where you have a company that has different parts to it. And if you add up the value of all the parts, it's materially above what the whole company is trading for in the stock market today. And that can happen quite often because maybe a company has a core business, and that's what investors are focused on, and they value the company based on that. But then there may be something else that they own that's totally unrelated, like some big piece of real estate or some other business. And then there are some other approaches, what I call jockey stocks, which is really companies that are run by a great jockey. It's, again, the horse racing kind of analogy, where you have a CEO who is not just great at running the business, but also great at what he does with the cash that the business generates, okay? Because once the cash is there, there are a lot of options, and you can destroy a lot of value as a company or create a lot of value based on what you do with the cash. So it's especially relevant for companies that have a ton of cash on their balance sheet. You might make an acquisition. You could overpay for another business just because you fear you're going to miss out on the next trend, and you take that hard-earned cash and you could basically waste it. Or if your stock price gets low, let's say there's a financial crisis and the stock gets hit and it's trading way below what it's worth, the company could actually take the cash hoard and buy its own stock in the stock market and create huge value. Because if it's just sitting there, the cash is maybe earning 0, 1, 2%. But if you're buying your own stock at yields of 10% or more, you're going to create huge value. So I want to maybe get into a couple of these quickly and then take questions. But these are basically these buckets we just talked about. And I'm not a huge fan of buckets because once you get into that, then it becomes a little bit more mechanical. You know, you find a company and all of a sudden you're thinking, well, what bucket does it fit in and how do I have to analyze it? When really it should just be common sense. You should just take a company, imagine you own the whole thing, and think like an owner basically from scratch. But nonetheless, so let's just touch kind of on some of the key features of some of these types of companies. So these deep value companies where you're buying, you know, maybe some factory type business for less than it would cost to create the factory. These are generally hated stocks. And if you look at it historically, people have overreacted on the negative generally. So this guy, Jerome Boss, he's a successful investor who just invests in these hated companies. So he says it's kind of contradictory that you buy what no one else wants and then you outperform. And it just takes a certain mindset to be comfortable doing that because everyone around you will say, oh, you're not very smart. And imagine if an investment doesn't work out, you're really going to not feel very smart because everyone was telling you all along, and then that's what happened. So even when people start off like this, they can't sustain it for very long because after a while they just think, you know what, it's too hard and I can't handle it. So I'm going to move on to one of the more comfortable approaches where you buy great companies and, you know, pay more for them, but at least no one's going to tell you that you're making an obvious mistake. But then they actually do outperform. So, and it's kind of the reward for the discomfort, if you will. These are some takeaways that I basically have in the book related to this chapter on deep value. And I'll just kind of highlight the first one, which is we start with the price of the stock. So when you talk to Jerome Boss or one of the other investors who focus on these kinds of companies, the first thing they'll talk about is, wow, this is so cheap. And then after 2 minutes, you ask them, well, what does the company do? So they really just care that it's really cheap, you know, kind of the bargain basement pricing. And here's an example of a company that somebody presented at one of the online conferences we've hosted for investors. And the basic thesis here, this is a tire manufacturer in Korea that has a few different types of stock. So it gets a little complicated, but basically you can invest in this company in a few different ways. And the basic way, the common stock, is cheap. But then there's another way through the preferred stock where you're getting this exact same thing 50% cheaper than other people are paying for the other thing. And the other thing, they're paying more basically because it's a little bit more well-known or has more trading going on. So sometimes people will care about liquidity a lot in a stock. Oh, can I buy $10 million of this in one day, or does it trade very little? When actually how much it trades has nothing to do with how much it's worth, right? I mean, if you own a house, it trades zero, and it's still worth whatever it's worth. So the preferreds trade at a big discount to the common, and that's just an example of a deep value investment.
John, can you go back to the previous slide?
Sure.
One quick question. On point number 2, you said no voting rights, but confer same economic benefits. Can you explain that point?
Sure. So depending on the class of stock, the voting rights may be a little bit different, which just means do you get to decide who is on the board of directors and so forth. And companies do that for different reasons. Actually, Google has, I think, 2 or now 3 classes of stock. And the purpose there is really to make sure that the founders retain operating control of the company and can make the decisions that are needed for the future, because you wouldn't necessarily want an outside investor to come in and buy up enough shares to get voting control of a company and then do something that may move the stock in the short term but may destroy value in the long term. So one way to do that is to sell non-voting stock or shares that have fewer votes to public investors so that they can never gain a majority of the vote. And these preferreds have no voting rights. But generally, you know, this is a Korean tire manufacturer. Even if you're buying the stock that has voting rights, there's no practical difference because you're not going to be able to influence it in any way, either way. So the voting rights are not worth very much, but you're getting the same economic benefits. So if the common shareholders get $1 dividend, you get $1 dividend, but you're paying half the price for the preferred stock. Some of the parts, there are many examples of this kind of, yeah.
There usually is something that, so if those stocks are 50% cheaper and they will always be 50% cheaper, then why would that be better?
Yeah, that's a great question, and actually they can stay cheaper for a very long time. Sometimes a company may, if the company is smart or cares about value, they may actually buy that preferred stock themselves because it's so much cheaper than the other stock. Like they could sell the other stock in the market and then use the money to buy back the preferred. But absent that, you're right, the disparity could continue. But would you rather buy the one at 50% discount and maybe it stays at a discount? Maybe not. You know, the discount could get wider, but I think probabilistically you're much better off buying it at a discount. And it turns out that over time they do tend to work out because some large shareholders will move in and they'll just kind of start putting pressure on the management to eliminate this disparity.
Does it also work, for instance, sometimes preferred stock actual development, like preference because of information?
Yeah, absolutely. And sometimes preferred stock, or often it's a better security because it ranks ahead of the common. In case of bankruptcy, it may have certain preferences. But because a lot of investors are so focused on liquidity, meaning being able to, if I decide tomorrow I want to dump this stock, being able to dump it in one day versus taking a week to sell it slowly, they put such a premium on that that the preferred, even though it's a better security, may trade at a big discount to the common. And to a long-term investor, that makes no sense. So you can buy that preferred slowly, you can sell it slowly, and over time you're going to make more money. There are some examples of some of the parts are so obvious. They're at very large companies. So there was a couple of years ago Vodafone, which is a big mobile phone carrier based in the UK, owned a large stake in Verizon Wireless in the US. And Verizon Wireless publicly traded. So just that, the value of that stake was so great that the rest of Vodafone was being valued extremely cheaply. But investors didn't care to see it for a while. And it's hard to predict these things, but usually it works out. And then after a couple of years, all of a sudden it worked out, and you actually make a great return, even though you didn't quite know when that disparity would be removed. And so sometimes it makes sense to analyze the different parts of a company separately, right? And then sum up all those values to decide what is this business really worth. And I'll just make kind of a side comment here. So whether you're adding up different parts or just using an earnings yield or what have you, you really need to know or basically have an estimate that you believe in that a company is worth before you can even think about investing in it. Because if you don't know what you think a business is worth, then there's no basis to make an investment decision. And I think that's often forgotten. Sometimes you'll just hear someone say, well, you should buy Apple stock because they're going to come out with a new iPhone. And there's no reference in that sentence to how much you have to pay for Apple. Could be 100 billion, could be 200 billion. So maybe the fact that they're coming out with a new product is already reflected in that market value. And actually, if the new product is not quite as great, the stock goes down. So you really need to think about what is this business worth in the stock market and what do I value it at? If I had the money, how much would I want to pay for that company to own all of it and just make money off the cash flow of the company? And here's just kind of a classic example of a sum of the parts where you have this little company in India where they got 50 million cash. They have a big plot of land near Mumbai airport. And both of those things together are already worth more than what the whole company is trading for in the stock market. So you're actually getting the business, whatever it is that they do, which is an exhibition and IT parks business, you're getting that for free. And that may or may not be a good deal, but at least you've found something that looks kind of interesting, because if they sold that land or gave back that cash to the shareholders, you'd get your investment right back and you'd own this business. So that's an interesting type of setup, and that would fit in the sum of the parts category. I'll just touch very briefly on magic formula, and then we'll open it up for questions. Here we were talking about the two-factor screening, looking for cheap stocks and good companies. And Alan Bachman is an investor who focuses on that. And an interesting finding is that if you gave people the lists of those companies that rank highly on those two factors and told them, well, now that you have these companies, choose the best ones, or now use your own judgment to choose which ones you want to invest in, what they found is actually when people choose their own, they do worse than the mechanical screen does. And it's interesting, but it's also kind of intuitive, because there we go back to the discomfort of owning hated businesses. If they're that cheap, They're usually companies that have fallen a little bit on hard times, and when you're looking at that list, you're going to want to eliminate any company that doesn't feel quite right, but they're priced so cheaply that they'll actually outperform. And so I'll end it there. There's one more approach discussed in the slide deck that we're going to skip over now, but it deals with the quality of the management team. And the point that I just want to kind of leave with all of you is there's no secret, there's no magic to this, and the only way to do well in the long term is to find businesses where you feel like you're comfortable with it and it's cheap enough in the stock market that you feel like the return you're getting from the business itself is going to make it worthwhile. And Ben Graham, who wrote that original book on investing, he said in the short term, the stock market is a voting machine. And in the long term, it's a weighing machine. So in the short term, there's the beauty contest. There's all this noise out there. And when you turn on CNBC, they're always talking about this quarter or today even, or tomorrow, what's going to happen. That's just noise. Okay, there's no signal there. And but in the long term, there's that mystery, right? How do you go from a voting machine to a weighing machine? But I guess over time, the earnings of the business come in, and people settle down. Whatever emotion they had, on that day, dissipates. When there was the oil spill in the Gulf of Mexico, BP stock got killed because they were operating that well that had the spill. And that was the voting machine, right? People were saying BP is going bankrupt. And then as people started to think, well, what are the scenarios? How much could they have to pay? And even in the worst case scenario, if they had to pay like $20 billion to clean up this oil spill, they'd still be undervalued because the stock had gone down so much. And over time, the stock went back up because people realized what BP was actually worth. So with that, I'll open it up to any questions. Yeah.
My main question would be, so you always have to be, you have current market price, which is representative of the current prediction that other people have made according to similar criteria. So if you want to find some investment opportunity that is worthwhile, you have to make a better prediction than others are making. So, or you have to find one where others have made a bad prediction. This requires a lot of effort. So is it feasible for a small-scale investor who isn't going to put in $1 billion to profit from it to actually be worth the time?
Yeah, that's a great question. So the stock price does reflect the opinion of the market, and it's actually, just to be technical, it's not the actual stock price, it's the market capitalization. So it's stock price times number of shares outstanding. And it'll have a prediction built in, but you don't need to outsmart the market on the prediction necessarily, because you can just decide what you're comfortable with. So if the company is earning $1 billion in free cash flow or net income per year, and it's selling for $10 billion, that's a 10% yield. And you can say, well, I'm comfortable with that. Because again, we're getting back to the legal essence of a stock. It's part ownership of the company. You're not actually betting. There was that marketplace that got shut down online where you could bet on different things, maybe even things like that. How many iPhones are going to get sold, and if they sold above a certain number, you could actually get paid. Well, that's not what stocks are. Stocks are just ownership in the business. So if you're fine with 10% and you're fine with it growing very slowly, you're going to make money. The market may expect it to grow faster, but that's not going to take away your 10% yield. It does get dangerous when you're buying very expensive stocks, because there your yield from the business is so low that you really are betting on something great happening. And that's where, you know, outsmarting the market becomes much more important. But if you're just sticking with things that you're totally comfortable with, you don't need to worry very much about what the market is predicting. Yeah.
What are the top 3 to 5 positions in your personal portfolio?
I'm not going to get into it just because that can age fairly rapidly, although I do view myself as a long-term investor, but circumstances can change, and I don't want to make any recommendations here, and you shouldn't accept recommendations from anyone really, because they're not going to necessarily tell you when they sell the stock that they told you to buy. And also, you know, we talked about the discomfort of owning stocks that go down, and generally I want to only buy a stock where I am excited if it goes down 50%, because then I can buy even more. Okay? And if you have that mindset, you're going to be a lot pickier, because usually when a stock goes down 50%, you're really scared. You're thinking this is going to zero. So you need to just know what you think a company is worth, and then be comfortable with the downside. So you really need to do your own work, would be my. Yep.
John?
Since you're a value investor, would you say that you don't invest in areas like biotech, where the companies become public and there's no revenue? Right.
Yeah, that's right. And a biotech company could be worth a lot even if it has no revenue, but that's beyond my capacity to judge. And Warren Buffett once said, you need to know your circle of competence, but what's even more important is to stay within it. So it can be small, but if you stay within that, you'll do well. And if you venture outside of it, like would be in my case with a biotech company or many other companies, and it's okay to say, I don't know enough. Actually, that's what I would say with most companies in the stock market. You know, it's, to use a baseball analogy again from Buffett, it's a no-strike called game. So you don't need to swing at every idea that comes your way. Okay? The only thing that matters is the companies that you do buy, you're right on. Okay? And even there, you're not going to be right on every one. So stay within your circle of competence, and you'll do much better than if you venture outside of that. Maybe go to San Francisco.
Yeah, I have a quick question. Thank you for a great presentation and a great book. In the book, you mentioned about using American Association of Individual Investors data to be able to filter for some of these buckets. I wonder if you have recommendations on how one uses raw data in countries outside the US. So in Europe, I know you're based in Europe. How does one do that in Europe or any of the other countries, if you have recommendations?
Yeah, that's a great question. The data that exists for the US stock market is a lot more robust than what's available out there for Europe or other markets. So if you're looking at companies listed on the New York Stock Exchange or NASDAQ, even foreign companies, you can screen for those very cheaply. The subscription you mentioned is about $300 a year. And then the databases that will do a good job on Europe and the rest of the world may cost $20,000 or $30,000 a year. So if you want to go the low-cost route, there's really no great solution for Europe or Asia. You may just end up relying a lot more on the primary documents and doing the work yourself, which of course makes it hard to screen across many companies. You'll be kind of digging one by one unless you're willing to pay quite a bit of money.
I know you run a very well-respected newsletter, also by the same name, Manual of Ideas. I wonder, how do you go about looking for these companies? You obviously don't like go one at a time. Do you use a database, or is just names that show up through looking at 13Fs equivalent in foreign countries?
Yeah, so we've developed a few different idea generation methods over time, and we do have an internal database that kind of fills in some of the holes that exist in some of the more widely available databases. So we'll use that, and then we'll use some of the more serendipitous ways of generating ideas, like you mentioned, some of the filings by well-known investors and looking at what they own in Europe. So that's really what we do is we've built that internally over time. But if you want something off the shelf, it's probably going to be fairly pricey to cover Europe and Asia.
So would you say for an individual investor, the lowest cost option after the database is available in the US would be to maybe subscribe to a newsletter like yours, and that would be something that's the lowest cost, next available option?
Well, I'm not really sure about the lowest cost option. If you're looking to screen mechanically, the Manual of Ideas really won't be the right tool, because we don't allow you to screen on our whole database. We actually select ideas and present them each month. So I'm not sure what service you would want to go with for just screening.
Thanks. That's a great response, though. I mean, it's a good idea. Thank you so much. I have one follow-up question, but maybe I can come back afterwards again.
Okay, there's one. Yeah.
I wanted to ask if there's a danger in picking stocks that are very public and many people might be buying as fanboys. I want to take an example. I'm not there's Google and there's Microsoft, which have a somewhat similar market cap. The price-to-earning ratio of Microsoft is twice lower. So technically, Microsoft makes twice more money than Google. And is there a risk that Google, just because, hey, Google is cool, they do everything well, is going to attract a lot of attention, and people are going to think, oh, they're going to be great. And then Microsoft people don't believe in it, even though it's making all that money. Well, could that be just collective hallucination or something, or is it just the long-term cost assessments of the market?
So that's a great question, and it kind of goes back to the pari-mutual betting system nature of
John,
how
could we
stocks
request
are
you to
priced
repeat the
in the
question?
market. The question is really Microsoft versus Google as potential investment. The questioner says that Microsoft is basically half the price of Google as measured by PE, and whether that makes Microsoft a better investment. And it's very hard for me to judge. So it's really impossible to say, but it is true that, as you say, the market is making a judgment that Google will do much better in the future than Microsoft. Otherwise, you would want to buy Microsoft because you're getting twice the bang for your buck in a way. So just to kind of illuminate that with some sample numbers, basically if Google and Microsoft were the same market value, Microsoft right now, the way they're valued, is making twice as much money as Google. Now, in absolute terms, it's not true because Google has a bigger market value and so forth, but And you know, that's just a judgment that every investor needs to make. But as I said earlier, you can actually just look at other things if you're not comfortable making that judgment. And generally, you know, that's not an extreme situation. You know, usually you'll find much more extreme situations than that, you know, where research in motion is trading at 1% of the valuation of Google, okay? And something that extreme can be also more rewarding if you're a little bit right in some aspect. You know, Microsoft and Google, you're kind of, the judgment becomes pretty difficult to make. And it also may depend on your time horizon and other things.
John, we won't hate you if you said Microsoft here.
Sorry, say it again?
I said you could say Microsoft if you really believe it. We wouldn't blame you for saying that here.
Well, I don't believe it, but I'm not sure I'd say it if I did.
So can I ask one more question, John?
Sure.
Among the, you follow so many different investors who are of all different sizes in terms of how much capital they manage and how popularly they're known outside the value investing circles. Who would you rate as like the top 2 or 3 investors, not just from a performance point of view, but people you kind of look up to and you look forward to reading their shareholder letters and who have really meaningful insights that are not popularly known otherwise?
Well, there are a lot of investors I admire. If you want people who are really not well known, they're actually in this slide deck. Phil Ordway is somebody I have a little bit later. He manages a fund and does just extremely good work. He's kind of an up-and-coming fund manager that I think will do very well. Then there are fund managers that are kind of not as well known as Warren Buffett, but I'd say Bruce Berkowitz or David Einhorn, definitely among the folks I respect the most. And there's actually a list of investors in the book as well, if you want to look at it. And we kind of update the list for our monthly edition all the time. So we want to track people that have had good track records and that we know do very good work on the companies they invest in.
Are there specific shareholders, fund managers whose shareholder letters you look forward to?
Well, it's sometimes hard to get on some of these lists because they manage private partnerships and are not allowed to mail those letters out widely. But Phil Ordway has a letter, as does Michael Schern. Seth Klarman's letter is great. It's sometimes hard to get. And there are probably a number of other guys on that list that we could email around, maybe.
Thank you.
Okay, so thank you very much for this talk. Thank you.
Thank you.